This is our Forex blog for April 12th, 2013. And before I go over our normal stuff, I like to show, again, like I did yesterday, the power of using trend lines. Obviously, our tools, using the currency meter, the indexes, finding the strongest currencies. But one of the easiest ways of trading is just simply use trend lines, and when they get broken, you get into trades. I have automated systems that take my trend lines when there's a break. It gets in, I drew it on here. And sometimes you don't want to have them line up with, the absolute perfect places, because that might mean getting into a trade, possibly 8 to 15 or 20, maybe even 30 and 50 pips later. You want to get in as soon as possible, and you don't know if a trade's going to work out or not. Obviously, this one did. I got a humongous number of pips out of this one. This trade right here also worked. Last night I got into a trade here on the breakout that failed, so I lost money on that one, and then it went short when the trend line here broke, and I made money on that one. And the same thing with the euro dollar. It probably was either here or here where it got into a trade and lost, went short here, and you can see the second it goes underneath that level at 93, it went from 93 all the way down to around 40. So that was a 50 pip move. I'm not sure exactly how many pips I got in that one. But the point is, you can make a living just with trend lines. And now I will go over how to use our other tools, so when you're sitting there trading, you know which currencies to buy and sell, when to get in, when to get out. Very easy to trade. All right, on to the regular part of our blog. This is our currency index, where I create an actual chart based on all the dollar pairs, all the euro pairs, all the Swiss pairs, Australian pairs, New Zealand pairs, CAD, pound, and yen. So for the yen here, I'm looking at the dollar yen, the euro yen, pound yen, Swiss yen, CAD yen, Australian yen, New Zealand yen, and basically creating a chart. And this gives you an absolute wealth of information, and it'll let you know which direction to trade each of these currencies. Let's scroll back and take a look where you would normally start the day trading, 3 o'clock. Notice a couple things on the chart here. The yen has a daily trend that's up, weekly trends down. It's above the hourly moving average and has been at the start of the European session for about almost 10 hours, 8 to 10 hours. And it's above the hourly, you want to focus on buys. Below the hourly, focus on sells. The point of control tends to be another filter. Above that, you want to look for buys. Below that, you want to look for sells. And when it's stuck in between the point of control, yellow, and the average hourly moving average, it tends to be very choppy. So you really want to avoid currencies that are stuck in between these two. As you can see, they tend to be very choppy. And so our tool not only helps you find which currencies to trade, but it also tells you when to stay out of them. Notice this little chop phase right here. Chop phase, little choppy phase. So basically, once a currency busts through, it's trending up, above the point of control, above the hourly. At 3 o'clock, it makes sense to look for buys in the dollar, although you got to be cautious. The weekly trend's down, so don't be getting your hopes up on 50, 100 pip moves. Typically, if the longer term trend's down, you can expect 5 to 20, 25 pip moves, maybe 30. If all the time frame trends are up, you'll occasionally get 100 pip moves. So this one you would have really wanted to wait to here to sell it. The euro here at 330. So everyone likes to trade euro pairs. So let's take a look at selling the euro versus the dollar at 3 o'clock. And also the yen started going up a little bit before 3, but we'll take a look at it at 3. Some of the higher probability trades would be to, and it doesn't matter what time frame chart you use for this. I use 4 and 5 pip range charts. I also sometimes use tick charts to perfect my entries if I'm not exactly sure based on the range chart. Okay, so we're basically looking to sell the weak euro versus the strong today dollar. And the dollar really, the euro started getting weaker earlier, and most of the time we take trades when it breaks the hourly moving average. You saw from my earlier part of the video, I had a trend line set up expecting a possible reversal in the euro today, mainly because it was up too much and it didn't do what I thought it would do yesterday as far as having enough strength to justify continuation today. So that's why I took my short on this. But even if you were watching the hourly here, you'd go short here. Using your other tools, you start looking at it at 3 o'clock, and you have this nice trade here. Anytime you take a trade where you risk a super tiny amount and you're never going to catch 100% of the pips, so let's just say you got this amount here, that's still 4 to 5 times bigger than what your risk is. And a lot of times when you have strong trends like this, there's some continuation trades. You wait for a pullback. Maybe you would have made 8 or 9 pips on that one, and so forth. Let's take a look at the euro yen. And remember, the yen started getting stronger, significantly stronger at 2. So at 2 o'clock, we're really starting to look for sells. Here's the 2 o'clock time, and it's already underneath the hourly. It has been for the last few hours. And you have a nice little sideways rectangle kind of wedge pattern breakout right here at 2. Now, if you missed the 2 o'clock one, luckily at 3, when the euro really started getting weak, the yen was going up from 2. The euro started to get weak at 3. You have this nice, beautiful trade here. You want to draw your fibs from here to here. It's probably going to show, the fib target, something like that. Let's go ahead and draw the real thing on here just so we can see. And most of the time, the market's going to work its way down, to these fib targets down here. Or if you drew it off of the first wave here, normally the 1.618 is a good place to get out. So you're short at 24, you're out at 74. 50 pip move or risking less than 10 pips. Now, if you don't want to use a minute-based chart, again, I rarely do myself, but it's easier to illustrate in class. So using our technology indexes, the currency indexes, you don't really need to worry about what time frame you use. You can use 2 minutes, 3 minutes, tick charts, range charts. Here's what it looks like on a 3-minute chart. You have a nice little pullback right here, kind of goes down, tremendous amount. But here's what it looks like with a 50 tick chart. And you hit 50T, and it will put a 50 tick chart. It has to build these bars from tick data, so it has to download the tick data first. Let's scroll back and look at that. You can see the benefits on a tick chart in that you're looking for this trade. You would have actually gone short a little bit higher, and that's the main reason why I personally use tick charts and range charts, because it has smaller risks. Unfortunately, I got rid of the previous line. It might have been something like this. Instead of maybe getting into this trade around 22, you're in this trade around 29 for 9 pips earlier entry for a much tighter risk. You're risking this instead of this. And obviously, anytime you cut your average risk down while not affecting how big your wins are, and you can scalp this. You can get in, out, in. It goes sideways right here. Typically, I'll exit half, and the other half here. You get in. It's kind of chopping around. Usually, I'll get out of those type of trades right here. You got 10 pips from this one. Even though it did fall 20 pips, you probably wouldn't have got out of that unless you already saw it fell, and you would have got out right here. But you probably wouldn't have made 18 pips. Let's just round down to 10 on that one. The second one, you're in at 10. You would have made about 15 on half, 25 on the other half, so we'll round that up to 20. So you made 20 plus 10, 30 pips, plus the first trade here, maybe 20. It's a nice day trading the euro yen. And I like the range charts. So here's what it looks like on the range charts, so you can see for example's sake. And also on the range chart, the entry is very similar. You can see, you can spot the rate of increase right here. As soon as it goes below that first down bar's low, you're risking 5 pips plus 1 plus whatever the spread is. So the loss is always less than 10 pips. And again, you can scalp this. Anytime you get an up down pattern on a range chart, it's a reversal pattern typically. So when it does it on the lows here, I'm kind of expecting a move up. I would have probably got out of half my trade here, and then I typically will draw my fibs on there and tend to get out of the other trade here. I probably myself would not have taken this because it's already down 1 wave, 2 waves, 3 big waves. I would expect a reversal down there. So I tend to not push my luck, but you can certainly take every trade. Some days the market makes 5 waves. I just try to trade based on what I feel comfortable with myself. So again, we knew the euro was weak, the dollar and the yen were strong. We know to avoid pairs that are chopping around in between all the support resistance like that. You would avoid this from here to here. You would have taken a short here. You would be looking for longs above here. Avoid it during here. Look for shorts here. Obviously, the euro was quite weak. The Australian was chopping around when it broke down later in the day at 5. What was strongest at 5? Well, the yen certainly was strong at 5, although the yen is very close to its upper containment band. So I like the dollar at 5 because it just broke out an hour before. It had a chance to go down, but it didn't. It found support here at the average price for the previous day. So I like at 5 o'clock just because it has higher potential upside movement. This one's already at a likely reversal area with our containment bands. I'm going to take the Australian dollar, and this is how you kind of anticipate using just an ounce of common sense. It doesn't take more than an ounce, just 1 ounce. We're looking to sell the Australian dollar at 5 o'clock. And luckily, this chart looks nice because it was underneath the hourly, had a false breakout above it, came back down. You have a nice little trend line underneath here, even at 3. If you were looking at it with trend line types trades, you would have taken that. And then coming up to 5, you can see it kind of went up again. You never know if the trend's down until it breaks this level here, but with the hourly right above it as resistance, there's going to be tons of selling there because the trend's down. It makes sense to get short. And this is, again, one of those likely charts where you're going to be better off using a range chart for a more comfortable entry. Here's the Australian dollar 5 pips per bar chart. And if you don't like the way it looks, you can go down to 4 pips per bar, 4R. It doesn't really matter, anywhere from, depending on the currency's volatility. At 5 o'clock, we were, or even before 5 o'clock, we were looking for reversals. You might have sold the low of that bar with your stop above here. Always draw your fibs on the previous wave. More than likely, that was a fib target. We'll go ahead and, after you draw thousands of fibs, you'll tend to, be able to eyeball that. And that's a good place to get out. You're short, maybe we'll round down to 40. We're out of this trade at 17. You made 23 pips while risking the absolute minimum. 5, in this case, 4 pips. You get short right here, so your stop is a pip or 2 above that bar's high. You're risking, less than 10 pips, and this is how much you made. Anytime you can have a tiny risk with tremendous odds of huge wins, you got to pull the trigger. Now, before I end today's blog video, let's go over the perfect oscillator. Perfect oscillator helps you not only find entries, but also improves your exits. When you see this dip below the minus 80, it's probably gone down too much. It's going to reverse. So if you happen to be short here, you're aware around 315 it's probably going to reverse. You're probably going to get out of your trade here. If you got short again here and it's coming down, and you see a little bit after 5, it's down statistically too much, you can just put your stop above each bar's high, and just, if it wants to keep going down, it's down statistically too far, it's below the 1.5 band, it's very likely to find support, resistance here. You locked in, another 15 pips of profit by just letting it work its way. This trade right here, it's above the 80 level. The trend is clearly down on the day. It's anyone looking at the chart, even a 6th grader can see that. So when you see it having gone up too much with the perfect oscillator, you look for sells. Obviously it doesn't work all the time. When it's below the lower bands, it's a little riskier. If you, had gone short right here, you would have had a small loss. But if you shorted again right here, because the same situation happened, you can see it fell 10 to 15 pips. So you lose 7 pips, you make 15. You can see that two times there, it fell. Most of the time, it's going to be in your best interest to watch this. Notice how it nailed the high. That's why I call it the perfect oscillator. It's not perfect, it's not 100%, but it's certainly most days 70 to 90%. I've seen days where it's 100%, but it's even higher probability when you see a trend's down and you only sell the upper ones. Or you can, when it goes above the upper band like that, look for sells when it breaks down. They're not all going to work. This one here is a failure. This one here, it went above the band and back down right here. You're short, made a little bit above the bands and back down here. That one failed. This one went above the bands and back down. You made a little bit on this one and this one. And let me just show the euro dollar. Most people like to trade that one. And just get a feel for, because this is all probability. Obviously this one here failed. The market continued down. It did find the low down here. It went sideways for about an hour and a half. it did nail the absolute low of the day. So if you think it's a wise idea to buy below our lower containment bands, because the majority of the time that contains price, and if the perfect oscillator happens to be at or below the -80 level, you can get into some of these huge 50 pip counter trend moves. And again, notice, right here, and the market went up 15 pips, and it went down again here. You actually have divergence on that one because that was a quick spike down, and the moving averages were starting to slope upward. Anytime that happens and you get a quick spike down and it forms a double bottom, that's a high probability trade there too. But it's a very hard trade to teach new traders, so I kind of avoid divergence type trades like that. But that's how you use the perfect oscillator.